Good afternoon from Europe, ladies and gentlemen. It's a great pleasure participating in this Silver Town Hall meeting. Many thanks to O&M and to Endeavour Silver for inviting me. My name is Ronald-Peter Stoeferle and I'm managing partner and fund manager at Incrementum and Liechtenstein, and I'm the author of the annual In Gold We Trustreport. So let's get into the discussion. Well, first of all, a brief introduction. We're based in Europe, in Liechtenstein, a very small country in the center of Europe. And what we're doing is asset management, especially in the precious metals and commodity space. Many of you might know the annual In Gold We Trustreport that we publish for 15 years now already, and which is the most widely followed publication on gold. And we reach roughly 2 million people with this publication, and we're putting it out totally for free in German, in English, and also in Mandarin. And it wouldn't be possible without the fantastic support of our premium partners, really the creme de la creme of the gold and silver sector. And of course, Endeavour Silver is also a proud premium partner. So thank you very much for that. Let's jump into the discussion. First of all, I think, ladies and gentlemen, we are seeing historic monetary and fiscal stimulus. And from our point of view, it will lead to a surge in price inflation. Now, Herbert Hoover said, "Blessed are the young, for they shall inherit the national debt." And in the book, Lords of Finance, they say monetary policy does not work like a scalpel, but more like a sledgehammer. And we're seeing effects of both this monetary policy, but also of fiscal policy at work in financial markets. Now, as you can see on this slide, the big difference between the great financial crisis and the COVID crisis of 2020. From my point of view, now we're seeing basically unlimited quantitative easing all over the globe. But now we're also seeing very, very aggressive fiscal stimulus. And this cooperation, this very close ties between fiscal and monetary policy is something that has definitely changed. And the new head of the Treasury, Janet Yellen, the former head of the Federal Reserve, I think we cannot overestimate the symbolic character, the symbolism of this move by Joe Biden. It is telling us, well, it is not only fiscal policy that is supporting us, it is also monetary policy. And those two very, very close and powerful actors will act together now. Just to give you a view about the size of fiscal and monetary stimulus in 2020, it amounted to 33 trillion US dollars. Just in Western Europe, it was $6 billion US dollars of fiscal stimulus, which is 30 times larger than the Marshall Plan back in the days, measured in today's monies. So this size is truly enormous. And what you can see on this chart is the M2 growth rate, which is now at the moment significantly higher than in the highly inflationary 1970s. And there's also a big difference to be seen compared to 2008, 2009. Back then, M2 growth collapsed. Now, in the middle of the crisis, M2 is surging. So that's one big difference. The second thing that I would like to emphasize is that M2 growth rates and inflation are highly correlated. You can see that so far inflation rates are still pretty low, but this correlation is tight, and M2 growth per capita has already risen significantly. And as I've said, it's truly an enormous, one could say, off the charts size of monetary stimulus. If we compare it again with 2008, 2009, it's significantly larger. It's also much larger than anything that we have seen in the 1970s. Now with the new president, Joe Biden, I think this is not going to end. A small debt produces a debtor, a large one an enemy. And Joe Biden already said, well, this 900 billion stimulus is only a down payment. And the now 3.3 trillion of total stimulus spending is just the beginning. So we are, or the US is heading into a program of permanent stimulus. And the Wall Street Journal, they asked the question, well, it's not a question of if government is going to run out of other people's money, but when. Now, ladies and gentlemen, I know that at the moment, we don't see any big inflationary moves yet. And one of the main reasons for that is velocity. So it's basically telling us because of the COVID crisis, we are now seeing that nobody is making any big plans. We don't see any big investments by corporations. People are quite hesitant to make big investments, to make traveling plans, etc. But as soon as this whole uncertainty is coming out of the market, velocity will pick up. And actually, velocity has already stabilized. Now, this enormous amount of liquidity that was created over the last couple of months will meet rising inflation. And this is the recipe for surging price inflation. Now, from my point of view, the vaccine will be the light at the end of the tunnel. It will improve this picture, this bleak picture, this loss of confidence will come back at some point over the next couple of months. And I think we're at the beginning stage of this process. Now, we just published a special report on inflation. It's 40 pages long. It's called The Boy Who Cried Wolf, and it's available totally for free on our webpage. Now, how can we prepare against the surge in inflation? Abraham Lincoln said, by failing to prepare, you are preparing to fail. In this special report, we analyze the best hedges against inflation. Obviously, gold is not the worst idea. As you can see on this chart, gold had a tremendous year in 2020. It was up 24% in US dollar terms. It was up 22% in Canadian dollar terms. It was up 18% in Japanese yen. And most importantly, gold is rising in every currency now. Gold has made new all-time highs in every currency last year, or we can say the purchasing power of those currencies measured in gold has made an all-time low last year. What about silver? Silver performed extremely well in 2020. It was up almost 50% in US dollar terms. It was up 44% in Canadian dollar terms. Since the year 2006, on average, silver is up 11%. Now we know that silver is extremely volatile, but based on our report, and we published more than 350 pages about gold last year, and will publish probably a report that is probably even longer this year on 27th of May. Based on our main thesis that gold is in a bull market, silver should outperform gold. Now, what you can see on this chart is the gold to silver ratio since 1960. Last year, this ratio, this exchange rate between gold and silver, it basically made an all-time high at 125. So with 1 ounce of gold, you could have bought 125 ounces of silver, which is truly off the charts. Now, normally, the median is at 58. And over the course of a bull market in gold, silver normally outperforms gold. So where can how high can silver rise? Well, if we see a price of gold at roughly 2,300 this year, which is our base case, then normally the gold silver ratio should fall to levels around 40 or 50. So that then we would come up at silver prices at new all-time highs at 55, at 60. So just to let you know, if gold continues to perform well, silver will perform tremendously well. Now, let's talk a bit about mining stocks and commodities. The party has just begun, or we could also say the party for the US dollar is over. From my point of view, the US dollar has started a secular bear market. Now at the mark at 90 in the Dixie index, so the US dollar index, I think there will be some sort of a bounce, but sooner or later we will break below this massive support line. And what does it mean? Well, a bear market in the US dollar is normally a bull market for commodities. You can see this very, very tight correlation. And we can see that commodities really woke up to life last year. So from my point of view, commodities are a great investment going forward. Why? Because commodities are dirt cheap. Have a look at this chart. It's showing you the ratio of the GSCI commodity index versus the Dow Jones. You can see that relative to stocks, commodities are at the lowest level ever. We're even lower than in the 1970s. So commodities are tremendously overvalued. And I think that with this fiscal stimulus, with this green wave, we will see a renaissance of commodities. Miners are still very inexpensive relative to gold. Same goes for silver. A ratio of the BGMI, the Barron's Gold Mining Index, and gold is telling us that relative to gold, the miners are extremely inexpensive. And the miners really did their homework over the last couple of years. They strengthened their balance sheets. They got their cost structure under control. So now they're real cash flow machines. From my point of view, I've probably never in my career seen the balance sheets of the mining sector at a healthier level. And this bull market, this party has just begun. Now have a look at previous bull markets. You can see, well, it's not the shortest bull market, but so far the performance is clearly in line, and we haven't seen any parabolic explosion as we normally see at the end of every bull market. So it means that actually I think the best days are still ahead of us, and this mania phase is about to come at some point. Now, where will we go? Chris Cole, one of my favorite asset managers, he said, we need to think outside the paradigm of the last 40 years if we wish to thrive over the next 2 decades. Well, gold and silver, of course, as well, are still extremely underowned in institutional portfolios. You can see that commodities at the moment are only 3% of the total portfolio, while gold compared to the total portfolio is at the moment 0.15%. And silver, I don't know, but it's even lower. But now we're seeing that institutional investors are joining the party again. What you can see here is gold held in ETFs as a percentage of US equities. And you can see that Goldman Sachs, for example, announced the acquisition of the Perth Mint physical gold ETF. So something is happening in the space. And that leads me already to my conclusion, ladies and gentlemen. After the COVID crisis comes the debt crisis. Rising price inflation is not a tail risk. Negative real rates are the new normal. The renaissance of gold in institutional portfolios has started. Mining stocks and commodities are still largely underowned. And gold silver, and miners are on the way to many new all-time highs. That's it. That was a really brief and quick wrap up of my thoughts, my convictions. I hope you enjoyed it. And now I wish you a fantastic evening with Endeavour Silver. Thank you very much for taking the time. Take care and see you soon. Bye bye.